Welcome, curious minds. Today we're diving headfirst into the ever-turbulent world of market sentiment, especially right now when those, spooky scare stories around the fall start to really ramp up, the ones that headlines that make you second guess everything. So our mission today is to cut through that noise. We want to use data to challenge some really pervasive market fears. We're specifically talking about the idea that a top-heavy market is automatically bearish, that whole dread around September seasonality, and some big questions about portfolio strategy. Our deep dive today is based on a really compelling piece. It's titled Extreme Market Concentration is a Buy Signal, written by Alec Young over at MoneyFlows, dated September 15th, 2025. In this article, it doesn't just offer an opinion. It directly challenges some deeply ingrained market beliefs, things many of us just kind of take for granted. So we're going to unpack these narratives, look at the hard data, the facts, and hopefully give you a clearer, maybe even surprising perspective.
Yeah, it's really illuminating when you look at it. How often conventional wisdom, even when there's a kernel of truth in there, can actually steer investors wrong. Our goal isn't just to skim this article. It's to pull out the critical data points, the key insights, and really connect them to the broader market picture for you. It helps you look beyond just the scary headlines, Understand not just what the market's doing, but maybe why certain patterns get misinterpreted so often. It's about empowering your understanding, really.
All right, let's unpack a big one then, this idea that extreme market concentration, a few huge companies dominating the index is somehow a sign of, like, impending doom. It's a narrative you hear constantly, right? Every time a few tech giants lead the way, people hear it and immediately think bubble or, uh-oh, instability, apparently.
Yes, yeah.
But our source here, Alec Young, he argues the complete opposite. He actually contends that extreme market concentration is a buy signal. Now, that really flies in the face of what most people assume. How can that be? How can something so top-heavy be, well, positive?
It's a great question. And the data tells a really compelling story here. Let's actually look at the numbers. It's true, the S&P 500 has become way more top-heavy in 2025, no doubt about it. The biggest 10 companies, they now make up a full 40% of the index's market cap.
40%? Wow.
Yeah, and just to put that in perspective, that's a huge jump from only 17% just 10 years ago?
Yeah.
Back in 2015? So yes, the concentration is definitely real. But, and this is the crucial part, this isn't just about size or weight in the index. What you need to grasp is that this concentration reflects an equally massive share of the S&P 500's earnings, those same top 10 companies. They now account for 32.5% of the S&P 500 earnings. That's also way up from 17% in 2015.
Oh, okay, so they're big and they're making the money.
Exactly. They're not just big. They are incredibly profitable. Take the second quarter, for instance. Those top 10 stocks, their earnings per share EPS grew by an impressive 25%. Compare that to the rest of the S&P constituents. They only manage about 8% growth.
Big difference.
Huge difference. So what does it all mean? Well, by boosting the overall index profit growth so dramatically, this rising concentration has actually improved equity returns for the whole index. The key takeaway here really is, don't automatically assume market strength is weakness just because a few giants are leading the charge. These aren't just, popular stocks. They're fundamentally strong, highly profitable companies that are driving the entire market's performance upwards. It points to bullishness, not bearishness.
That's a really powerful way to reframe it.
Yeah.
It makes logical sense. If the biggest players are also growing profits the fastest, yeah, it should lift the whole market. But doesn't this reliance on just a few names introduce maybe a different kind of risk? Like, what if one of these giants stumbles? Does the source talk about that potential vulnerability?
Yeah, that's a fair point, and it's definitely a concern you hear from investors. Our source does acknowledge a concentration, sure, but it emphasizes that these aren't just any large companies. They are typically leaders in their fields, with strong competitive advantages, moats, and pretty resilient business models. The data seems to suggest that when you have such powerful, profitable entities driving the market, their individual strength generally outweighs that perceived concentration risk. Historically, this kind of top heaviness, especially when it's fueled by strong earnings like this, has often been a feature of strong bull markets, not necessarily a sign a crash is coming. So the focus really stays on the underlying health, the fundamentals of these leading companies.
Okay, that makes sense. Shifting gears slightly, but building on this idea of concentration, let's talk about market breadth. So this term, it refers to how many stocks are actually participating in a rally, right? How widespread the gains are. And conventional wisdom, your gut feeling almost, suggests that strong, broad participation is always healthy. It's desirable, indicates a robust, sustainable rally. But our source, Alec Young, presents this really fascinating, counterintuitive insight. He argues that weak breadth can actually be a great recipe for big market gains. That just completely flips the script on the traditional view. How? How can less participation lead to more gains?
It does sound backwards, doesn't it? But let's dig into the data again to see the why. Right now, we are actually seeing what's considered a weak breadth reading. Only about 29.2% of S&P 500 stocks have outperformed the index itself over the last 12 months.
So less than a third are beating the average.
Exactly. And just to clarify, weak breadth means fewer stocks than usual are really participating broadly in the market's upward move. It signals a narrow rally where just a select group are pulling most of the weight. Now, if we connect this to the bigger picture, the historical data going way back, like to 1928, offers this really compelling story. Weak breadth readings, like the one we have now, they've actually tended to forecast average returns of 15.4% for the S&P 500 in the following 12 months.
15%.
Wow. And the thinking is often that weak breadth can be typical of the early stages of a new bull market. You get a few strong leaders emerging first, kind of proving the market's new direction before the broader participation really kicks in. Now look at the flip side. When breadth is ultra strong, meaning tons of stocks are outperforming, you might think, okay, even better returns ahead. But surprisingly, stocks have historically averaged just 7.4% gains 12 months later in those situations.
Less than half.
Right. And that's often because widespread participation can signal a more mature market, maybe even getting a bit overheated, a market where perhaps most of the easy games have already happened. So for you listening, it's really crucial to consider that broad participation might not always be the best predictor of future returns. Weakness can sometimes signal opportunity.
That's a powerful distinction. Strong breadth, maybe signaling maturity, versus weak breadth signaling an emerging bull run, maybe led by those concentrated, profitable companies we just discussed. It's like the market sends out its strongest runners first, and the rest eventually follow. So when does that broader participation usually catch up? Is there typically a lag?
Oh, absolutely. There's definitely a lag. Think of it like a train leaving the station. The engine pulls away first, right? And then the rest of the cars slowly pick up speed. The data suggests that once those initial strong leaders establish a clear upward trend, investor confidence gradually builds. Then capital starts flowing into a wider range of companies. This can take several months, sometimes longer. Institutions, individual investors, they often need to see that sustained performance from the leaders before they feel comfortable broadening out their investments. So yeah, the later stages of a rally often see breadth readings improve as it matures. It really ties together, doesn't it? Concentration and weak breadth can be linked signals of a market getting its footing.
Okay, fascinating stuff. Let's tackle another one. Another common fear that gets so much media chatter every single year, the dreaded September signal. Bears just love to beat this seasonal drum, don't they? And, I mean, to be fair, the S&P 500 has fallen in 4 of the past 5 Septembers. It's easy to focus on those really nasty outliers, too, like September 2002, that was an 11% drop. September 2008, equity slid almost 9%. Then you had September 2011, down 7.2%. And more recently, September 2022, large cap slid 9.4%. You see those numbers, and it's hard not to get a bit nervous.
It's true. Those historical examples, they definitely grab your attention. And the overall average return for September, minus mere 0.7%, yeah, it is the worst of any month on average. But here's what often gets missed. That average performance is really skewed lower by those few really nasty outliers you just listed. If you dig a bit deeper and look at the median decline, the middle value, it's only half as bad, about minus 0.35%. And maybe even more importantly, 45% of Septembers have actually been positive since 1950. So it's clearly not some kind of guaranteed loss. It's just a month with high variability.
Okay, so the average is bad, but the typical experience isn't as bad, and it's positive almost half the time.
Exactly. And if we connect this to the bigger picture again, it's easy to miss the really crucial factor that often dictates how September actually plays out: the market's momentum heading into the month. The data clearly shows that when market momentum is strong, September has actually been a pretty good month for stocks, historically speaking. It's like the market's underlying health can just override any seasonal superstition.
Momentum being the key. How do we measure that?
Well, our source gives specific data points. The S&P 500 ended August at 6460. That's well above its 200-day moving average, which was down around 598.61. Now, the 200-day moving average, as you probably know, is a widely watched technical indicator. It helps gauge the long-term trend. When the market's above it, it generally signals a healthy upward trend. And historically, going back to 1950, when the S&P 500 enters September above its 200-day moving average, the average price gain for that month is actually a healthy 1.3%.
Positive 1.3%.
Positive 1.3%, with a 60% positivity rate, meaning it was up 60% of the time in those instances. Now, contrast that significantly with when the index enters September below its 200-day moving average. In those cases, you saw an average September price decline of 4.2% and a positivity rate of only 15%.
Huge difference based on the trend.
Massive. So it really suggests it's not the calendar date itself, not some curse on September. It's the market's fundamental strength or weakness leading into that month that truly seems to matter.
That's a really crucial distinction then. It sounds like we shouldn't just fear September in a vacuum, but really understand the market's health before September even arrives. So it's not the month, but the trend that's your friend, as they say.
Precisely. The source puts it really simply. The trend is your friend heading into September. That's the quote. It's all about filtering out the noise of those historical averages, which get skewed by extreme events, and focusing instead on stronger, more immediate signals like momentum. It's a good insight for you, encouraging you to look beyond simplistic seasonal patterns and actually analyze the underlying market strength or weakness when you're evaluating potential monthly performance. Context, as always, is just everything in investing.
Okay, makes perfect sense. So bringing it all together, what does this actually mean for your portfolio right now? A lot of investors are grappling with that classic dilemma. Should you be trimming your cyclical winners, the sectors that usually do well when the economy's growing? Should you trim those after their big run this year? And maybe lean into more defensive stocks. The source notes, communication services, industrials, they're currently leading the pack performance-wise, while healthcare and energy are lagging. It feels natural to want to rebalance, right? Take some profits, look for value in the laggards.
Absolutely. That's a very common instinct, a very common approach. But what's fascinating here is the source directly advises against trimming those winners, says it would be a mistake right now. Instead, the suggestion is actually to consider buying cyclicals on any dips.
Buying the leaders on weakness.
Exactly. Now, that might seem counterintuitive if you're just thinking about locking in gains or balancing after a good run-up, but there's a solid rationale behind it. First off, cyclicals still dominate the sector rankings. Technology, industrials, financials, consumer discretionary work. They're scoring the best. And it's not just past performance. They've enjoyed positive earnings revisions all year, and crucially, they generally boast a much healthier 2026 earnings outlook compared to defensive sectors.
So the future growth looks better there.
That's the argument. What makes cyclicals attractive now is their leverage to economic growth. If the economy expands, even moderately, these companies tend to see higher demand, better sales, stronger earnings growth. Think about tech and industrials, often in the forefront of innovation, capital spending. Materials, energy, they benefit directly from global activity. Specifically, the forecast is for technology, materials, energy, and industrials to grow earnings the most. That positions them for continued leadership, assuming the economic picture holds up.
Okay, but what about that economic picture? As we connect this to the bigger picture, a lot of investors are worrying about slowing growth and that whole tariff-induced sticky inflation thing, that concern. Stagflation fears slow growth plus high inflation. It leads to worries the Fed might only cut rates once, keeping things tighter than people want.
Right. And the source acknowledges those worries head on, but it takes the other side of that argument. They contend that, yes, the economy is slowing, but crucially, it's not stalling. And they argue that any inflation bump from tariffs will likely be short-lived. Supply chains adjust, demand finds a new level.
So less pessimistic on the macro front.
Less pessimistic, exactly. Their outlook is that once these pervasive stagflation fears start to ease, and they expect they will, then cyclical sectors are perfectly positioned to lead the next leg higher in this rally. So the advice translates to avoid bottom fishing in defensives right now. That strategy of buying beaten down stocks hoping for a rebound, maybe not the best place to be. Of course, you always need some diversification with solid best-of-breed defensive names in a portfolio. But the core advice is lean into growth. Especially with the Fed expected to cut rates this week, the actionable insight is to gravitate towards those economically sensitive companies, the ones institutions seem to favor outperform. It's about being strategically positioned for, hopefully, a continued economic expansion rather than a retreating into defenses based on fears that might be, overstated. So the question for you is, are you positioned to benefit if economic fears ease and cyclical leadership continues?
That's a really bold stance, quite confident, especially with all the ongoing chatter about inflation and what the Fed might do. So the core message is essentially, trust the underlying fundamental strength, the earnings power of these cyclical sectors, and try to look beyond the immediate macro anxieties because they might just be temporary noise.
That sums it up pretty well. It's about having conviction in that longer-term earnings outlook and maybe some faith in the resilience of the economic cycle rather than getting completely swayed by short-term headlines or that very natural urge to de-risk after a good run. The source seems to suggest that the macro narrative, while obviously important, might be overstating the negatives right now, and the fundamentals of these leading cyclicals still point towards continued outperformance as the economy finds its footing and maybe those inflation concerns eventually subside. It's definitely a proactive stance rather than a purely reactive one for portfolio construction.
Wow. Okay. What a deep dive today into some really entrenched market beliefs. We've definitely challenged some significant narratives. First, looking at market concentration not just as a risk, but potentially as a bullish signal, really driven by the sheer profitability of those leading companies. Then, flipping the script on market breadth, seeing weak breadth not as a warning, but as a potential predictor for strong future returns, maybe signaling the early phase of a bull market. Then we found the crucial nuance in September seasonality, getting beyond the scary headlines to understand how critical market momentum is, and finally exploring the strong data-driven case for leaning into cyclical sectors, trusting their earnings power and the economic cycle's resilience, even with those macro anxieties swirling around. This deep dive has really shown the power of, well, going beyond the common assumptions and actually looking at the data, just like Alec Young's MoneyFlows piece really pushes us to do.
Yeah, what's truly illuminating when you look across all these different points is that consistent theme, isn't it? The profound importance of actually following the data instead of just getting caught up in the crowd's latest fear or our own ingrained biases. And that closing thought from the source, it offers a particularly powerful piece of advice for you, the listener. It encourages you to be early. Don't wait for the media to finally sound the bull whistle, because, as it warns, by then the train will have left the station. So this raises, I think, an important final question for you to consider as you move forward. Where in your own understanding of the market, or perhaps even in your own portfolio decisions, might you be able to go with the flows, meaning recognize and maybe act on these kinds of data-driven insights and position yourself early rather than just waiting for everyone else to agree?